Why do the smartest investors fall for the same lie every single time a new technology promises to rewrite the rules? The pattern that sank fortunes in the radio age, killed dreams in the dot-com crash, and wiped billions in crypto is being replayed right now with AI at the breaking point. The "this time is different" myth is everywhere, yet 12 critical signals say history is about to repeat. If you think your retirement or home equity is safe, what comes next could force you to reconsider everything. So what are the 7 unbreakable stages? And which one are we in now? Every great bubble begins with a spark, an innovation that genuinely changes how people live, work, or communicate. In the 1920s, radio turned living rooms into newsrooms and concert halls. In the late 1990s, the internet transformed the world's idea of business and connection. And in the 2020s, crypto promised a new financial order, upending the rules of money and trust. Each time, this real breakthrough called displacement set off a wave of excitement and investment. Prices started to climb, and for a while those gains tracked real progress. But something else always followed: cheap money. As interest rates fell and lenders loosened standards, borrowing became easy. Investors borrowed against homes, portfolios, even future paychecks, pouring fresh fuel onto already rising prices. This is credit expansion, the oxygen that turns a spark into a blaze. With so much money chasing the next big thing, the focus shifted from profits to possibility. In the euphoria stage, metrics stopped mattering. In the dot-com era, companies were valued on clicks and page views, not earnings. During the crypto rush, market capitalizations soared on memes and message boards. A handful of winners, RCA, Cisco, Amazon, Nvidia, drew in billions, while most others rode the wave. The crowd believed in new rules, convinced that old measures no longer applied. Underneath the frenzy, leverage quietly multiplied. Borrowed money, margin loans, and options piled up, making the system more fragile with each new high. By the time the party hit full swing, few noticed how far prices had drifted from reality. The early warning signs were there, hidden behind the headlines and the hype. Insiders always move first. At the height of every mania, those closest to the numbers begin quietly offloading shares, hedging, or locking in gains. In the late 1920s, RCA board minutes record private discussions of reducing exposure, even as public statements stayed bullish. Dot-com founders and executives filed Form 4 reports showing record sales in late 1999, hedging with collars, selling into strength, or cashing out before lockups expired. Crypto architects, from token founders to exchange executives, transferred millions of coins to private wallets or liquidated holdings as prices peaked, with on-chain data revealing the scale of these exits. Once insiders begin their retreat, the cracks start to show, financing dries up, deals that seemed certain fall apart. In the radio era, margin calls rippled through brokerage accounts as RCA's price slid. Dot-com startups missed payroll, defaulted on loans, and saw vendor financing collapse. Crypto platforms like FTX and Terra unraveled when promised yields could no longer be paid, exposing leverage that had been hidden in plain sight. Then comes the point of no return: critical mass. Warning signs stack up. Leverage is everywhere, risks pile into the same crowded trades, and policy tools lose their power. Attempts to stabilize markets, rate cuts and emergency liquidity prove too little or arrive too late. Fragility peaks. A single shock can trigger a cascade. As lenders pull funding, margin calls accelerate, and forced liquidations sweep through portfolios. Revulsion follows. Panic selling becomes the only exit. Years of gains disappear in weeks. Careers, retirements, and reputations are swept away, leaving a long, slow path to recovery. The script never changes. It only accelerates. Now, with the blueprint complete, the evidence from past bubbles stands ready for comparison. In the 1920s, radio swept across America, turning a technical marvel into the centerpiece of everyday life. RCA, led by David Sarnoff, became the face of this revolution. Sarnoff, hailed as a visionary, promised a future where every home would tune in and investors rushed to buy shares. Newspapers touted radio as the engine of a new era, fueling a surge in public optimism. Margin debt soared as ordinary people borrowed heavily to buy RCA stock, convinced that prosperity was now permanent. Brokerages offered easy credit, and the idea of risk faded into the background. RCA's price outpaced its actual profits, but few seemed to care. Boardroom records from late 1928 show Sarnoff and other insiders quietly discussing how to reduce their exposure, even as headlines cheered the boom. This widening gap between paper prices and fundamentals was driven by leverage and blind confidence. By the time the market turned in 1929, the culture of leverage had left countless investors exposed, and the shockwaves spread far beyond Wall Street. The radio bubble had run the full script, setting a pattern that future tech manias would only accelerate. The late 1990s turned Wall Street into a casino of new rules and wild bets. Traditional accounting was tossed aside in favor of eyeballs. The number of website visitors became the only metric that mattered. Startups with no profits, sometimes not even revenue, raced to IPOs, swelling the market with 457 public offerings in 1999 alone. Telecom giants handed out billions in vendor financing, propping up sales to unprofitable dot-coms and inflating balance sheets with IOUs. The stampede was so frenzied that even companies with negative earnings saw their stocks triple on the first day of trading. Underneath the surface, the market's strength was thinning. A handful of big names, Cisco, Yahoo, and Amazon, carried the indices while most new IPOs quietly collapsed. Mark Cuban, who sold Broadcast.com to Yahoo for $5.7 billion in stock, watched the mania from inside. He locked in his gains with a complex hedge, using equity collars to protect his Yahoo shares from the coming crash. When the Nasdaq collapsed, Cuban kept his fortune while most insiders and employees saw their paper wealth vanish. The dot-com bubble did not just pop, it erased fortunes at record speed, showing how quickly euphoria turns to regret. Crypto's cycle played out at breakneck speed. In 2021, billions flowed into decentralized finance protocols, with new coins and exchanges promising endless yield. Investors used their crypto as collateral to borrow more, then looped those borrowed funds back into the system, multiplying leverage with every turn. On-chain data showed collateral loops reaching 3 to 5 times the original deposit, risk compounding far faster than in traditional finance. At the center, exchanges like FTX acted as both bank and casino. Sam Bankman-Fried's empire quietly funneled user deposits into high-stakes bets, masking insolvency behind complex ledgers. When confidence cracked in November 2022, a single rumor sparked a $6 billion withdrawal rush in 3 days. Internal chat logs from FTX revealed executives scrambling as the collateral web unraveled. Token unlocks dumped fresh supply onto the market, triggering forced liquidations across the board. Billions vanished in a matter of hours. What took years in the dot-com boom collapsed in weeks, proof that hidden leverage and instant liquidity can compress a full bubble cycle into a single, brutal whiplash. 12 signals now flash together, each one a red flag on its own, but catastrophic in combination. First, the Magnificent Seven stocks account for nearly a third of all S&P 500 market value, a level of concentration last seen before the Great Depression. Valuations stand at extremes. The S&P forward price-to-earnings ratio hovers above 21, and the CAPE ratio sits near 37, far above historic averages. Breadth has collapsed, with most index gains driven by a handful of names while the majority lag behind. Executives at tech giants have unloaded record amounts of stock, as shown in quarterly SEC filings. Retail investors are piling into short-dated call options and margin debt, echoing the leverage seen in past peaks. Liquidity cracks show up in widening bid-ask spreads and sudden funding stress. The yield curve has uninverted after its deepest inversion in decades, a classic recession signal. Earnings quality is deteriorating, with GAAP and adjusted numbers drifting apart, and AI-related capital spending muddying true profits. Corporate debt amassed at low rates now faces refinancing at higher yields, squeezing margins and buyback power. Berkshire Hathaway's cash hoard, now at $157 billion, signals institutional caution. Venture capital funding has dried up, with startup failures and layoffs rising. Commercial real estate stress, from a refinancing cliff to bank balance sheet pressure, increases equity correlation and stress. Finally, global shocks, from energy disruptions to geopolitical tension, raise the risk of a sudden liquidity crunch. When every warning light blinks at once, history shows the cascade can begin from almost any direction. Capital preservation starts with clarity. First, map your portfolio. List every holding, fund, and ETF, then check for overlap. The same top stocks often hide inside different funds, stacking risk without warning. Trim oversized positions, especially those that have run farthest. Next, focus on defense, not prediction. Hedging with index put spreads or collars can limit drawdowns without betting the farm. Size these to what you can stand to lose, not what you hope to gain. Keep cash reserves on a ladder, short-term, safe, and accessible. Yield traps often punish latecomers, so resist chasing extra basis points. Set rules to trim after parabolic moves and stick to them, no matter what the headlines say. Avoid short-dated options. The odds rarely favor the buyer when volatility spikes. Accept moderate growth and protect your core. In late-stage bubbles, patience and discipline beat precision every time. Missing the last 10% is nothing compared to surviving the first 40% down. Today, $6 trillion in United States market value rides on 7 stocks, more than Japan's entire economy. As concentration and leverage peak, defense is not pessimism, it is survival. In every bubble, the rules change only for those who forget them. This time, risk remembers, even if memory fades.